In fact, people will still remember that under all the rubble, there are thousands of balloon loans gone bad that serve as the villain that started it all. Today, many do not fully understand what a balloon loan is, and how a seemingly simple loan could nearly cause the collapse of major economies. The interesting appeal of a balloon loan is that borrowers pay interest for the first few years and make no payment for the principal. It is no wonder why many finance people also call them interest-only loans. In a traditional loan, you know that your monthly payments will apply for both the interest for the month and partial principal of the loan. So, you can see that this scheme calls for a much lower monthly payment on the part of the borrower. Normally, you take a balloon loan structure for mortgages, but it is not unusual for borrowers to use this scheme for other types of large loans, such as auto loans. What sets a balloon mortgage apart from the other loans is that it does not fully amortize over the life of the loan. Ideally, the borrower will make payments over a predetermined period of time, usually 5 or 7 years. Then, at the end of the period, pays for the full remaining balance of the loan at once. Obviously, you can surmise that the remaining balance would be huge, hence the term balloon payment. To get the monthly payments on balloon loans, lenders usually divide the loan over a standard 30-year period, but some lenders use other computation methods such as interest only. Some balloon mortgages have a reset option, which takes effect at the end of the loan. When the borrower requests for a reset, it means that he wants the lender to automatically recalculate the mortgage at the current interest rate. However, when no such option has been provided, it can mean that the buyer will either sell or refinance the home before the end of the term. Here's an example. Let's say that a buyer gets a 7-year balloon mortgage to buy a home. The lender will then require him to make equal monthly payments at a fixed interest rate for 7 years. Often, the rate will be considerably lower than a traditional mortgage loan. At the end of the 7 years, the lender will ask the borrower to pay the remainder of the balance of the loan. The borrower can then pay in full or refinance the loan with the lender or a different lender, or simply sell the house. And here's another example. Let's look at what's going to happen if the borrower takes out a balloon loan for $300,000 with a term of 7 years and an interest rate of 4.5% with an amortization period of 30 years. He will not be paying off the loan for that entire 30 years, but will only make payments for 7 years. He would then be left with a balance of $262,598 after 84 months of making payment. This will be the total amount that the borrower will have to pay as a lump sum payment. For borrowers who are looking for low and fixed interest rates on their loan, this is a fitting financing scheme. This is also a type of mortgage that is comparatively shorter than most types of loans because it normally lasts for 5 to 7 years. A serious word of caution though. Expect a huge remaining loan balance at the end of the term that the borrower has to pay in full. So if you're a home buyer who expects to receive a windfall or is looking for a higher income within the next few years, this could be for you. Or, if you're an individual who often relocates or one who is not planning to stay in your newly acquired home for a long time, can probably benefit from this kind of mortgage. That's it for now. On our website you can find more posts as well as calculators and other financial tools. Considering a balloon mortgage? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get the best free financial educative videos.